Hey, can you guys hear me now? Jay Cussler, no audio, can't hear. The Zimmerman, no sound. Can you guys hear me now? Give me a one if you can hear me. Give me a one in the chat. All right, looks like we are getting sound. Perfect. All right, well, I guess I'll take it back from the top. Welcome to Capital Cosm. Sorry for the long delay in videos, but just had some personal matters to attend to over the last few weeks. Energy prices have been acting really strange lately. The world is falling apart at the seams. World War III seems to be at the doorstep, or as close to us as it's ever been. Oil price is about $80, $82.73, I want to say. Last time I checked. Uranium is $74.50, still hitting near decade-long highs, and gold still hovering above $2,000. So what exactly is going on around the world? We've got the World Bank here saying that oil prices could hit $150 if the Israel-Hamas conflict intensifies. So we're going to take a look at all this energy news. We're going to take a look at some technical analysis, and we're going to take your questions in the chat as well. Sorry about that, guys. It looks like I've just been talking to an empty mic all this time. But let's go ahead and dive into it. Nothing in this video is financial advice, by the way. I am not a financial advisor, so please do your own diligence. All right. So let's go ahead and dive into this chart. Crude prices could rise to more than $150 a barrel if the conflict in the Middle East escalates, the World Bank warned on Monday, risking a repeat of the 1970s oil price shock if key producers cut supplies. So it's really interesting that they kind of hearken it to the 70s oil price shock. I think we're a lot less dependent upon us being here in the West. This is where I'm broadcasting out of here in the United States. I think we're a lot less dependent on the Middle East for our oil today versus the 70s. So we might have a little bit more resilience to supply shocks from that region. But let's go ahead and dive into the article here. It says, in its quarterly commodity market outlook, the multilateral lenders said a prolonged Israel-Hamas conflict could drive big rises in energy and food prices in a dual shock for the commodity market, still reeling from a Russia full-scale invasion of Ukraine. So essentially, a second wave of inflation could be underway here with this conflict brewing. Now, if you look at the 70s, for example, we had three waves of inflation. You know, you'd have a peak year over year, then you'd come back down and somewhat normalize, and by somewhat I mean like around 3 to 4% year over year growth. You're still growing, but at a declining rate. That's kind of the black magic that these economists play on the readers, on the public. You're still, inflation didn't really stop. You're not getting deflation. You're not ever coming back down to the old prices, but the growth of inflation has kind of subsided. So but what they're saying here is that commodities could be coming back. Commodity prices could be really boiling over soon because of this conflict in the Middle East. All right, so it says, the latest conflict in the Middle East comes on the heels of the biggest shock to commodity markets. Since the 70s, Russia's war with Ukraine, said Dermot Gill. So he's a chief economist at the World Bank. Under the bank's baseline forecast, so this is without the Middle East conflict, before the Middle East conflict in view, they were actually predicting commodity prices to come down 4.1% over the next year. So you see how this war has kind of changed the narrative. It's kind of flipped the script a bit, because war is always inflationary. War is never deflationary. Because if you think about it, war. What does war do? Well, how does war occur? Generally speaking, and there's an old saying that says, when goods stop crossing borders, bullets do. So essentially, war stops trade, and the stopping of trade increases the supply, decreases the supply of goods, and lower supply, higher inflation, supply side inflation. So wars are always inflationary. I personally subscribe to the fourth turning model of the Neil Howe fourth turning model. Essentially, the upshot of it is, if you aren't aware of it, is that the United States, the world goes under is kind of moving under the undercurrent of this 80-year cycle, 80 to 100-year cycle, where you have genesis of a new system, new economic system, new governmental system. It reaches prosperity, and then starts declining towards the tail end of the 80-year cycle, and then starts deteriorating back down to where you have some massive transformational change. In the case of the United States, we had World War II 80 years ago. Before that, you had the Civil War. 80 years before that was the Revolutionary War. So it's about every 80 to 100 years, you have these revolutionary changes in the form of governance, and it always has to be precipitated through, unfortunately, with bloodshed, through war. And it does seem like we are entering that phase of the cycle now. So a lot of change on the geopolitical front is going on. BRICS is coming on the scene. You can say whatever you will about China and Russia and so forth, and whether or not they're paper tigers. I'm not here to discuss that, but the United States has been the West in general has been seeing a decline in its authority. Over the course of the last, I'd say over the last 20 years. I think we had peak America, early 2000s, late 90s, and it's really, we've kind of hit that third turning, if you will. So the third turning is kind of like the peak of a cycle, and then you come down towards the fourth turning until you eventually just have the big transformative change through war and whatnot towards the end of the fourth turning. But anyways, so they predicted 4.1% fall in commodity prices baseline before this conflict in the Middle East. Now they're having to rewrite their projections to potentially, and we'll get to it soon, $140 to $157 a barrel. And this is on a worst case scenario basis. Global oil supply could shrink by 6 to 8 million barrels a day. Okay? So that'll send prices down to $140 to $157 a barrel. Under small and medium disruption scenarios, prices could hit $102 to $121 a barrel, the report added. Current global oil demand is about 102 million barrels a day. So that is very interesting. So think about this for a little bit. Global oil demand is about, let's call it 100 million barrels a day, just to make it clean. So a 6 to 8% decline in demand would precipitate, in this case, according to this article. So it says a $6 to $8 million shrinkage in global oil supply could lead to prices shooting up to 140 to 157. So that's almost a doubling, a 2x of the oil price. So a 6 to 8% drop in the oil supply could lead to a 100% increase on the demand side, on the price side, rather. Isn't that interesting? That's how the price of these energy markets is set on the margins. So all it takes is one disruption to kind of like let this entire thing unfold. So I thought that was really interesting. The war began when Hamas. Okay, yeah, some additional color. I think we all know. Pretty much everyone understands what's going on. Benchmark Brent prices fell more. Okay, so actually before that, let's go to European gas prices this month jumped to their highest level since March as traders feared that pipeline disruptions would hit global supplies, but oil markets have mostly shrugged off the impact of the conflict. Yeah. So numbers came out for the EU. GDP, Europe is down. GDP is not doing too hot. I don't have the exact number, but I remember it not being as good as here as in the United States. 4.9%, if you can actually believe that. All right. GDP. It just kind of shows you that GDP isn't really an accurate barometer of economic health and stability. One of the examples that I've heard before is that, if all of us just buy, if like 100 of us just buy like OnlyFans subscriptions for $10 a month for 12 months, then we've created, $120, what is it, $12,000 in GDP just from watching OnlyFans. Like, that's kind of the flaw of GDP as a calculation of economic health. So it's not really measured. It doesn't really stratify or take into account the quality of the transactions, the gross transactions of an economy. It just looks at all gross transactions as a whole, kind of naively. So let's go ahead and get back into the article here. Benchmark Brent prices fell more than 3% to about $87 a barrel on Monday, having exceeded $89 a barrel after the outbreak. Well, it's actually back. It's actually down a lot more now. I think last time I checked, what are we at? It's 82.59 as of the time of this live stream. So it's fallen back down quite a bit. Crude oil prices hit a record $147 a barrel in 2008 on the eve of the global financial crisis. The World Bank said the global economy was in a better position to withstand a supply shock in October of 1973 when Arab members of OPEC cut exports to the U.S. and other countries that support Israel in the Yom Kippur War, quadrupling crude prices. Yeah, so that's kind of what we alluded to here in the start. The Middle East is less important for global oil exports than it was 50 years ago, accounting for about 30% of supply, down from 37% in the 70s. So a 7 percentage point drawdown in the supply share, or global supply share around the world. But 30% is still a big share, warned Ian Kos, the World Bank's deputy chief economist. When you think about it, oil prices, what happens in the Middle East does not stay in the Middle East. It has huge repercussions. But the report warned that there had not yet been a full recovery from Russia's invasion of Ukraine in February 2022. So yeah, so there's still the Russia-Ukraine theater of the global war situation that still hasn't been resolved. Russian oil has still been cut off from the West, and I know the West can still get it through roundabout ways from buying it from India and stuff like that, but it adds additional. It's like giving your. I think one good analogy is like giving yourself a blood transfusion from one arm to the other, right? You're going to spill blood in the process, and that's kind of what happens there. So it's a very inefficient way to transfer Russia's energy over to the West, and even that, it's not even that much. He told the Financial Times that a really negative outcome will come if an escalation in the conflict drives a persistent increase in commodity prices. I'm going to read it again. A really negative outcome will come if an escalation in the conflict drives a persistent increase in commodity prices. So, which would unleash another wave of inflation, which is what we talked about at the beginning as well, and force central bankers to act, which means, what that means, QE or QT. What do you guys think? I'm gonna leave that up to you. Drop me in the chat. With rising commodity prices, war in the Middle East, would the central bankers continue to tighten? Or would they finally give in to QE? If they give in to QE, then commodities go to the moon. If they give in to QT, quantitative tightening, then the interest on the debt, I don't really understand how places like the United States with a super high debt to GDP ratio would be able to finance the debt, to finance the war with the likes of Iran and Russia and potentially China. This would have severe consequences for food security in poorer countries already facing rising levels of hunger, according to the bank. Increases in oil and gas prices could also drive up shipping and fertilizer costs, making agricultural commodities more expensive. Higher oil prices, if sustained, inevitably mean higher food prices. So, get it while you can, folks. An escalation of the latest conflict would intensify food insecurity, not only within the region, but also across the world. Yes, even in your own backyard. So, let's go ahead and take a look at this oil price again really quick. So, oil, we are at $82.63. Take a look at this precipitous drop from 90. Goodness gracious. 3, 4, 5 big candlestick, red candlestick days. But I will say we did break down this support line. So one way I would kind of interpret this is the oil price could be seen as a de facto bet on stability in the Middle East. And what do I mean by that? If the market is selling oil, right? Because the price is coming down. They're effectively selling the prospect of a war in the Middle East or a greater conflict. So the market believes that this conflict between Israel and Gaza will stay confined to Gaza. Because if it wasn't, if you started having the likes of Iraq and Iran and all of these oil-producing Middle Eastern countries start to throw their hat in the mix, then these guys, the market, would bet for a higher oil price. Derek Cho says, hi, we know CapEx for oil is at a 10-year low. Oil companies using cash for stock buybacks and dividends as a depleted resource, that's not good. It should be at $120. Yeah, exactly. Oil at this level only means oil at a higher level down the line. So let's look into another article here. It's from CNN. It says oil prices are falling even as Israel steps up its war on Hamas. A spike could still happen, though. So let's see what they've got to say. Oil prices fell again Monday as concerns about the health of the global economy outweighed fears that Israel's move on the weekend to expand its military operations got to lead to a regional conflict. So essentially, yes. It's the market betting on the conflict staying contained within the Middle East. We'll see if that's actually true. Hopefully it is. Hopefully it doesn't spread across the region and across the world. I mean, these kind of things, if you study history, can escalate pretty fast. Brent crude, the global oil benchmark, fell 1.6% to $89 a barrel. In West Texas, WTI dropped 1.9% to trade at $84 a barrel by 8:47 a.m. So this is early morning today, October 30th. Last week, Brent fell at 1.8% and WTI fell 3.6%. It says here, market concerns about the health of the global economy and the implications for oil demand. So another way to kind of look at this is the market believes, or rather, oil supply could fall, but if demand falls faster than supply, you would still see a fall in prices, right? It's multifactorial. It's multivariate. You know, you can't just look at demand in isolation. You can't just look at supply in isolation. You've got to look at them in tandem, as well as other factors as well. Israel's ground offensive in Gaza has been widely expected, blah, blah, blah. World Bank said on Monday that resting up and funding could push global commodity markets, including oil markets, into uncharted waters. So yeah, potentially new all-time highs in oil and commodities. And, this is one of the reasons why I am in this commodity space. If you study history, these kind of conflicts, you can kind of see them coming. And as we kind of alluded to before, war is inflationary. It's never deflationary. So, and how do you hedge for inflation? Well, commodity. Well, how do you hedge for supply side inflation? Well, through commodities, which is what we do here on this channel. Policymakers will need to be vigilant. Chief economist at the World Bank said, if the conflict were to escalate, the global economy would face a dual energy shock for the first time in decades. Not just from the war in Ukraine, but also from the Middle East. So it's a double whammy. It's essentially a 1-2 punch. So yeah, it basically goes over the same article that we just went over from the World Bank. Commodity Market Outlook, published on Monday. Let's actually pull up that report. Excuse me. So yeah, here it says the global oil supply could shrink by 6 to 8 million barrels a day, drive up prices by 56 to 75% initially to $140 to $157 a barrel. And yeah, it doesn't seem like there's any. Oh, here's an interesting line. Policymakers nevertheless need to remain alert. The report says some commodities, wait for it, gold in particular, are flashing a warning about the outlook. Gold prices have risen about 8% since the onset of the conflict. Gold prices have a unique relationship to geopolitical concerns. They rise in periods of conflict and uncertainty, often signaling an erosion of investor confidence. So that's kind of the other side of the debate, if you will. Not debate, but argument. While oil might be coming down, you can kind of interpret that as a bet on a conflict intensifying. Gold has actually stayed pretty firm around this $2,000 level. And gold is a crisis hedge, which is what they just talked about. I know people like to talk about it as an inflation hedge and so forth. I look at it as more of a crisis hedge. And the fact that gold is still above $2,000 despite the oil drop off. I think that's something to look at. That's also a warning sign. So it says here, policymakers in developing countries will need to take advantage to manage the potential increase in headline inflation given the risk of greater food insecurity. Yes, so emerging markets are going to get hit the hardest from this, because at least here in the United States, we've still got the dollar. As bad as it is, domestically, internationally, the world needs dollars, and right now, there's going to be a strong demand on dollars from these emerging markets. Okay. All right. Well, let's pivot over to uranium, everyone's favorite energy. What's uranium been doing? Uranium has been hitting decade-long highs. Closed out today at 74.50. Another move up. I mean, look at this uranium chart here. This is an article from Zero Hedge. They've got the U308 spot price, and wow. I mean, this thing is a beaut. Continuing to make decade-long highs. The article says, hedge funds load up on uranium stocks, betting on dramatic upside. As uranium ore trades at record highs, several hedge fund managers are expanding their allocations to uranium stocks. Oh, really? More smart money is entering the uranium trade. We've looked at charts before that showed when ETFs like URA and URNM see sell-offs, the share of institutional investors goes up and retail investors goes down. So it's essentially retail selling into institutional smart money. With a conviction that an increasing embrace of nuclear energy of a green future, along with geopolitically rooted ambitions to reduce dependence on Russian oil and gas, means that the trend has a lot of room to run. Yes. Even though we've ran all the way from 20 some odd dollars, or actually, 20 some odd dollars in 2019 to $75 today, there's still a lot of runway with this thing, given the current landscape around the world. First, the IEA says that in order to meet net zero goals, which describes a state where carbon emitted into the atmosphere matches the amount removed from it, global nuclear generation capacity must double from 2020 levels by 2050. So within the next 30 years, we've got to double the nuclear generation capacity. In addition, nuclear energy coming to the fore as zero carbon emitting power source. It's also seen as a way for the Western economies to reduce their need on Russian oil and gas. The fact that Russia currently accounts for about 8% of the world's uranium reserves underscores the need to develop new supply sources. So let me posit something to you guys. With this Middle Eastern theater opening up in the last month, do you think this increases or decreases the chances of normalization between Russia and the West? I'll let you think about that. So, are we going to need, is that Russian oil and gas going to be more readily available or even less readily available in the future? Taken together, the uranium-friendly trends could potentially could power significant gains in the sector. Uranium equities could see dramatic upside, 50, 100%, possibly more. Terra Capital's Matthew Langsford said. So they're seeing as high as a doubling in the uranium stocks, possibly even more from where we're at. Personally, I think that's being a little too conservative, but we'll see. Langsford has been building positions in Denison and NextGen Energy, headquartered in Vancouver. NextGen is exploring new Canadian mine thought capable of producing a quarter of the world's supply. Yep. Then here you've got a chart of the top and bottom 5 share price performance. So CGN, and I don't really know the time horizon on this thing. Does it say? Yeah, I'm not really sure. So this is looking at stock per share performance. I don't know if it's within the last year or not. But CGN, Kazatomprom, Global Atomic, Boss Energy, your higher cap uranium stocks are outperforming your smaller cap. And it kind of makes sense. I mean, some of these smaller cap companies, they've got all these projects that they talk about that probably won't come into fruition. The larger cap companies is where the institutional money touches. They're not going to gamble with $5 million market cap, Johnny come lately, shitco uranium company. They're just not. So you're going to see capital flow into these larger caps first. And once retail gets wind of the trend, that's when you start seeing more money flow into these riskier shitco uranium companies. Family-friendly show, by the way. All right, let's go ahead and finish up this article. We're most focused on uranium miners in public markets. Arthur Hyde, portfolio manager at Segra Capital, told Bloomberg, for the supply and demand of this market to balance, we need new assets to come online. If you're going to insulate the United States, Europe, and Canada from the global fuel cycle, which is heavily dependent on Russia and China, the best way to do that is to build new mines, new conversion capacity, and new enrichment capacity. That's not to say everyone's exclusively paying on the long side. Hyde, for one, told Bloomberg he's thinking of shorting Cameco after a 70% surge in 2023. Meanwhile, he's bullish on UR Energy and Energy Fuels. That's URG and UUUU. So, but this is an article on Bloomberg. You know what they say? Once you start seeing these kind of folks over on CNBC and Bloomberg start to talk about this, then maybe it's getting a little too crowded in here, right? All right, let's go ahead and keep on this uranium theme here. Uranium demand hits decade high as nuclear renaissance gains traction. Rising climate change awareness is leading to renewed interest in nuclear energy. Yep, because the renewables just aren't going to cut it. Recent advances in small modular reactors and existing nuclear infrastructure position nuclear power as a viable, stable energy source. Increased demand and higher uranium prices signal the market's bullish outlook for nuclear, with the U.S. possessing significant uranium reserves. So let's take a look at the scale of nuclear power here in the United States. So you've got a chart here. You've got all these different energy sources, right? You've got fossil fuels, which includes natural gas, coal, petroleum, and other gases. You've also got nuclear. You've got renewables, which includes wind, hydropower, solar, biomass, etc. And then on this third column, you've got the share of all sources. So as of 2022, fossil fuels made up 60% of the electricity generation in the United States. Okay? Nuclear, 18.2%. Renewables, 21%. So, what this article is saying here, rising climate change awareness is leading to a renewed interest in nuclear energy with public support at a decade high in the United States, that basically means they can't get this number higher. So they've got to rely on this number to go up instead. Right? The renewables front, really hard to tap into. Nuclear, really easy return on investment from an energy return on energy invested point of view. I know it's not a perfect measure, but nuclear is, things like what? What is it, chat? Like, isn't it like 100 to 1? So, I mean, really, geothermal, from my chat with Simon Michaud, geothermal, and I'm trying to remember what else he alluded to. I think he alluded to nuclear as well, but I think geothermal and hydro may have been the other one that he was really bullish on. So let's take a look at the uranium price. Do some tech analysis, some TA. All right. Uranium spot price at $74.50. Boom. Check that out. And it actually overtook this last hump in 2011. So this hump here was $73. This was at the height of, or actually right before this is where Fukushima happened, right? And it just crashed everything down. So we're actually at highs not seen since the Fukushima crisis. All that negative sentimentality seems to be undone. Good job. Nuclear power. Joey F says 100 to 1. Yeah, that's what I thought as well. In terms of the EROI, energy return on investment for uranium, nuclear power. So yeah, guys, I mean, check this out. Are we going to make... We're going to break this $140 high. We'll see. The uranium miners are also doing okay, right? But you expect them to do a lot better given the current price of uranium, right? So here we are. We broke out of this squeezing pattern, and we're kind of back here. Kind of retesting this April 2022 high, if you will. We hit the October and September 2021 highs, tested that, failed the test, and now it looks like we're testing this high. But let's take a look at these candlesticks, see how we're doing. Closed out to the day in green form. Almost looks like a hammer candlestick. Not quite. The wick needs to be a little longer for that to happen. Let's look at them weeklies. Get a more informative view here. So the weekly so far, green candle, green hammer candlestick on the week starting on October 16th. Last week was pretty much a wash, I'd say. And today, starting off the week, starting off fairly strong. So we'll see where uranium heads. Let's look at uranium. Let's look at the miners versus the metal. So the miners are underperforming the metal, guys. It's not good news. We want the miners to outperform the metal. We want the miners to outperform the metal because we want capital coming into the sector, which obviously means more capital flowing into some of the more riskier assets, which would be the miners. So I'm kind of hesitant at the moment with the miners. The metal seems to be bullish, but the miners aren't. So the miners aren't. That means that's telling me something. We always have to, or not we, but I always like to interpret some of these signals that the market is sending us. So why would the metal be outperforming the miners? That implies that capital is afraid to. The market is afraid to deploy capital in some of the more riskier uranium assets. Why is that? If uranium was in a more bullish scenario, would capital be less afraid? Probably. So we always want. I'm not saying that the price of uranium is inflated or anything. Just something to keep in mind. The fact that the miners are lagging behind the metal, I just find that fairly disenchanting for the sector in the near term. Medium to long term, I mean, this thing's going to go crazy in the near term. Joey F says, the utility companies can afford all the way up 300-pound uranium with no real effect to their OPEX. Really, there's no demand destruction even at $300 a pound uranium. Plus, new supply will take 2 to 3 years to return. Yeah, I did read that article, Joey. And I think the person who threw out that number, he also said that the $300 number wouldn't be sustainable. So it would be like a huge spike up, but then it would also come down really fast. Joey F says, above ground inventories need to be drained until the market will have no choice to turn to new production. Sprott Physical will outperform near term, miners long term. Yeah, it's pretty much what I see as well. Near term, I'm kind of disenchanted with the miners, but they did rebound. They did break out of their squeezing pattern there that they've been building since the top of September or November of 2021. All right. Let's look at URNJ divided by URNM. So again, URNJ is the riskier asset. URNM is the more conservative asset in this case. And what do we see? Let's go ahead and look at a daily candlestick. It's actually been doing not too bad. It's been moving sideways. So we can look at that as good news. We want the riskier assets to move because that tells us that the market is more confident in the uranium trade. All right, guys, let's pivot over to gold. We alluded to in the show earlier in the show, gold is staying above $2,000, which is take it as you will, but gold is a crisis hedge. So the fact that gold is holding steady implies that the market isn't entirely convinced that the crisis in the Middle East will stay confined in the Middle East. Whereas a lower oil price, on the other hand, is sending us signals that the crisis is most likely going to stay contained. So we're getting two different signals from the market. On the one hand, gold is staying strong. On the other hand, oil is showing some weakness. So, really interesting. The gold price edged lower, rallied, and then edged back below $2,000 again. Once again on Monday. Hold on. I thought it was above 2,000. Yes, $2,005 at the moment. Yeah, and just, I mean, look at these green candlesticks over the last week. One, two, three, four, five, six, seven, eight, nine. Wow, nine consecutive green candlesticks. Uh, Today, not, we're back in the red, but not surprising. I mean, we had all these green candlesticks. I mean, there's got to be some sort of profit taking here to expect. I'm not really shocked there. But even so, I mean, since the conflict started here, it's been, just grip it and rip it. Insane. Insane. And you can clearly see gold breaking out of this resistance line. And we'll see how high it gets. We will see how high it gets. Let's actually look at gold. Haven't done this in a while. Let's look at gold divided by M2. And you've got to add in this huge coefficient because the M2 money supply denominator is so huge. You get like this super small decimal if you don't. All right, so gold. Let's look at the weekly. So this is gold divided by M2. So this is gold relative to the M2 money supply. And if you actually control for the amount of money in the system, I don't know, you'd have to you need a doubling in the gold price to get it back to where it was in June of 2011. It's the last high. We often call June of 2011 the nominal high of gold, but if you zoom out even more, the real high of gold is probably here in the 80s. I mean, you're looking at a 6x in the gold price just to get back to those prices. It's like, what, $12,000 gold? All right, let's go ahead and read through this article here on the gold, the $2,000 gold price. With the Federal Reserve expected to hold its key interest rate at near 2-decade highs this Wednesday, the gold price hits new all-time highs. Its most major non-dollar currencies, including the Chinese yuan, the euro, the British pound, the Japanese yen, ahead of tomorrow's Bank of Japan decision, and then the UK's Bank of England. So rates are rising, or rates are staying high, but the gold price is rising nonetheless. The U.S. Treasury Department will also announce its quarterly bond sales plan this week, wary of how its announcement in August, when it set a plan to borrow $103 billion of long-term securities the following week, spurred the sell-off in U.S. government debt, which had sent long-term interest rates surging to multi-year highs. Yeah, so the 10 years at 4.9%, something like that. So what do we got here? It says, ahead of Friday's late spike to a $2,000 gold price, hedge funds and other leveraged speculators in the COMEX gold futures in options grew their bullish positions by 22% from a week earlier. Again, you've got institutions buying this stuff, buying gold, pet rock, while cutting their bearish bets as a group by 26%. So we've got a chart here. We've got the gold price here in gold, this gold line. This gold line is the gold price. And then we've got managed money net spec positions. So the green line is essentially your institutional, the amount owned by managed money, i.e. institutional investors. And you can see a correlation between this jump in the gold price here and the amount of managed money. The amount of gold managed by money. Managed by managed money, institutional investors. And this is really interesting to look at, because like take a look at 2019, for example. You had a bunch of institutional investors come in 2019 here when gold hit $1,500, but they sold off into the high. So this is how the market works. They offload the more the price goes up, which is not what retail does. Retail buys more when the price goes up. So really interesting chart to look at. Overall, that pushed the net long position of managed money traders 117% higher to the largest since the beginning of August, according to positioning data from U.S. regulators. The CFTC for the week ending last Thursday. Yeah, so managed money, institutional investors are in this thing, and they haven't been in this thing as high as they've been since the beginning of August. It also meant speculators as a group bought the notional equivalent of 328 tons of gold in just 2 weeks. The second fastest fortnightly pace on the CFTC's near 2-decade records. They're emptying out the vaults. It's too risky to start a new gold short from here, as there is still potential upside. Wow. At $2,000, there's still potential upside. It's amazing. In contrast to COMEX derivatives, gold-backed ETF funds saw further liquidation last week with the giant SPDR gold, GLD, and IAU shrinking by 0.2 and 0.5% from the previous Friday, despite holding unchanged in size. So the ETFs are selling off, but physical gold is not. SLV also did not change in size Friday, growing 0.4%, so pretty much flat. The price of silver, which finds nearly 55% of its annual demand from industrial uses, rose 1.3% to $23.40 after falling 3.9% last week. So, yeah, we'll continue to monitor the price of gold. Let's actually look at the gold to silver ratio. Okay. So gold is fairly... I'd say it's slightly overvalued relative to silver. Now, again, using the same logic that we used with our uranium ratios, we want silver to outperform gold. Because when silver starts outperforming gold, gold starts going higher. Because silver catches a bid when retail money comes in and looks at the price of gold and says to themselves, well, I can't afford that. What else you got? Oh, you got some silver? Well, I'll take some of that. And that's how capital moves from safer to riskier assets throughout the course of a bull market. So that's interesting. 86.1. There's actually a lot of resistance at this level, guys. Look at all that resistance. Here, here, here. So we might be on the verge of something happening with gold. We'll see. I mean, how's that look? We broke out a couple weeks ago And we're hugging this support line as well. So we'll see. We'll see. One thing that I want to shift your attention to as well is copper price in gold. Now, why is that? Copper is often called Dr. Copper. Dr. Copper because it tends to prescribe the health of the economy. What do I mean by that? Copper is an industrial metal like silver. So when copper catches a bid, it's usually indicative of a stronger and healthier economy. So when we look at the copper to gold ratio, when copper begins outperforming gold, that tells us that the economy is improving. Stronger signs of the economy, right? I mean, you look at this thing historically, this is copper divided by gold, and you can clearly see the GFC crisis here at the very tippy top. And see all the way how it crashed all the way down. How the copper price relative to gold crashed all the way down from the end of 06 down to, beginning of 2009. You can also see it here during the COVID crisis. We bottomed here in March, and we peaked all the way out in November of 2021. Right? And we've been on a decline ever since. But what is interesting is that we have that same squeezing pattern that we saw in URNM, except with this copper to gold ratio. And we are right at we are at the point where you've either got to shit or get off the pot. If the price of copper moves on higher, that tells us the economy is getting better. If it moves down, that's a sign for a recession. Okay? And we are right here, guys. Yep, doesn't really make a difference if you look at it from a log chart, log scale or not. We are right here. Now, I'm going to throw you another curveball. I'm going to juxtapose the 10-year yield. And look at how perfectly it traces it. Because the 10-year yield in orange, right? The 10-year yield tells us the higher the yield goes, the lower in value bonds are. And vice versa, right? So an increasing 10-year yield tells us that bonds are lower in value. And a lower bond value signals, think about it this way. During times of economic boom, stocks rally, right? And bonds go down. Economic recessions, the other way around. Stocks go down, bonds go up. So when yields go up, it tells us that we're seeing signs of economic prosperity. When yields go down, it tells us that bonds are going up, which means recessionary forces are at play. Which makes sense because if you look at this copper to gold ratio, when copper goes up, it's more bullish for the economy, so does the 10-year yield. When copper goes down, so does the 10-year yield because the copper to gold ratio is bearish on the economy, and so is the 10-year yield. But something interesting has happened. There's been a divergence. There's been a divergence between the copper to gold ratio and the 10-year. Well, that's interesting. Let's zoom out a bit more. I mean, that's the full view of things, but why would that happen? Which metric is more likely to describe economic health? In your opinion? In my opinion, it's the copper to gold ratio. So you're going to need, when things are booming, you're going to need more stuff, and more stuff requires more copper. So then, why is the 10-year detaching itself from the economy? Is the 10-year sending us a signal of some sort that are we on the verge of a sovereign debt crisis? I mean, the payment on the interest on the debt, on the U.S. debt, I mean, you're looking at what? Almost $1 trillion now? So just thought that was interesting for you guys to look at. What are we at now? All right, guys. I think that's all I got for today. If you enjoyed this content, be sure to give it a like and share. Comment down below. Let me know what you think. Do you think, are you more trusting of the gold price or the uranium price when it comes to identifying conflict zones around the world? Gold is saying one thing, oil is saying another thing. We'll see which one is correct. Like, share, subscribe. Comment down below. Do all the YouTube stuff I'm supposed to tell you to do. And with that said, you guys, I will see you in the next episode. Bye, y'all.